Nice to have you with us once again. Joining me in the studio this time around is Warren Ingram, a certified financial planner and director of Galileo Capital, and also Hershel Jawitz, who's the CEO of Jawitz Properties. You've probably guessed by now that we are going to be looking at the property market, but specifically looking at where the market is and whether you should be in a rental or a buying situation right now. Thank you very much, gentlemen, for your time. Nice to have you with us. Warren, where do you reckon the market is right now?
In terms of residential property, I think it's starting to unlock. You know, maybe a year or two ago, you wouldn't see as many deals as we're seeing now. I'm sure Hershel will have a different view, but I think I'm starting to see more and more of our clients who've wanted to sell property actually getting the property sold. Whether those properties are being sold at a higher price than they were a year ago, I don't think so. I think it's just that a year ago maybe the deals weren't happening, and there are more and more deals now. But to me, it doesn't feel as if the market's suddenly, you know, shooting ahead again. It's not. It's still reasonably quiet, but there are transactions.
Hershel, would you agree?
Yeah, that's probably a pretty accurate assessment. So, you know, depending if you're a buyer, a seller, lessee, a lessor, but I think for all four parties, the market's in fairly reasonable shape. We're definitely seeing more buyer activity than we've seen for a number of years. I think buyers have a sense that properties are fairly priced, interest rates are still at historic lows and look like being at that level for some time to come. So the buying opportunities are good. I think sellers are seeing more activity. They're probably seeing more sold signs going up. Prices are moving gradually, so maybe 4 or 5% in some areas, at least with inflation. And I think similarly with the rental and the investment market, I think that it's in reasonable shape, and investors are getting a decent return, and tenants are paying a reasonable price for rental property. So I think this is the first time that for the market as a whole, it's in reasonable shape.
I'm picking up a sense here that it's sort of evenly weighted at the moment from a rental and a buying position. We were talking before we went on air about Professor Veruli's sort of 10-year cyclical number that he keeps coming up with in the property market. That's got about 5 years to run. So we're sort of in the trough at the moment. If there is cash around, I would imagine now would be a good time to actually be diving into the market and buying up those properties before they start accelerating on the back end of that cycle.
I mean, I have two counter problems here. One is I think interest rates, when they start going up, and none of us know exactly when that's going to be, surely not in the next year or so, but when they do go up, that tends to be bad for all properties. You know, rising interest rates are never a good sign for property buyers. The problem, though, is in this instance, rising interest rates will mean that the economy is recovering. It means that we're starting to try and control inflation again, and that will be a positive sign. It's probably one of the few instances where, you know, rising interest rates is actually a good thing, and we should be smiling about it. Yeah. So for me, I'm probably not going to rush into residential property in the next year just because the market's unlocked. I think I would still want to see other things happening as well. I'd still want to see demand rising a lot more than it has for now. Although, I mean, in any market there'll always be bargains, whether it be the share market or the property market, and that will apply today. But I wouldn't say just on a big view, at a big picture view, that yes, you know, now is a screaming buy, and a year's time you're going to regret having not bought now. I mean, I think in a year's time prices might still be roughly where they are now. But
I mean, Hershel, shouldn't people be factoring that in? Because I mean, I remember, and I'm giving my age away now by saying it, but I remember when interest rates were sitting in the 20%.
Yeah, late 90s.
And people had bought at an interest rate of 16%, and suddenly it was up to 22%. And they were actually having to offload their properties. Shouldn't you be factoring in an interest rate of, say, I don't know, what, 10, 12%? And saying, can I afford the payments on that? If so, if I've got the money now, let me buy the property.
Yeah, I think so. I think if you're not going to factor those increasing interest rates in, the banks are doing that for you. So I think that's one area we've seen the banks really tightening up in terms of the National Credit Act. They're not only looking at your gross income, they're looking at your disposable income, and they're certainly factoring in increase in interest rates and looking at your affordability. But I think a couple of factors. You know, I think your clearly investing in residential property is part of a portfolio, equity, stocks, bonds, and where you are
part of a mix.
Part of a mix. But I think your average investor at the moment, if you look, and especially sort of in the lower price ranges up to about $1.5 million, with interest rates where they are, and depending on how much you put down, the cash flow impact of investing at the moment at those sorts of levels is very positive. Interest rates are low, so generally your rentals are going to cover at least your mortgage repayments, and if not, at least a significant portion of your rates and taxes. So for a lot of investors, up until that level, you're probably at least cash neutral. You're not putting in money after earning your rental and paying your mortgage and paying your costs of running a property. And your yields, with property prices relatively stagnant and rentals sort of increasing at a faster rate than what property prices are, your yields are going up. So should you put all your money into residential property? Probably not. But I would say that most of the people I know, including myself, at some stage look back and say would have, could have, should have, didn't. And as long as you're taking a long-term view investing in a residential property, I think generally it's a good time to invest.
What's that smile about now?
Yeah. No, I mean, I think it's one of those things that's a difficult, for me, it's always a difficult market to understand, because I would compare it to buying property companies on the stock exchange, or if you're taking a view on property and it's such a concentrated investment in one property in one town at the tip of Africa, as opposed to saying, well, let me buy even an index, a property index, which is spread across thousands of properties across many cities, and I don't have to pay massive transaction costs. I don't have to maintain the thing. I don't have to manage tenants. So, I mean, I think buying a house is one thing to me. I understand that, but buying it as an investment is always for me a tricky one, because in effect you're making a business decision. You're actually saying, I'm now going to run a business. I'm going to manage tenants. I'm going to maintain the thing. And the costs I always think are high, and that's the thing I find uncomfortable. That was why I was smiling.
Okay, but then let's look at, for example, the commercial property market, which has been taking off over the last 2 or 3 years. There's been some great returns in that particular sector.
Yeah.
Is it not the time for the residential market to start ticking over and starting to pick up and seeing some returns?
Well, I mean, I look at residential property, and I agree with Hershel. It's a very long-term investment. You have to take that view. And for example, there's a fantastic index that tracks property prices over 400 years in the Netherlands, and it's house prices in one area. And over 400 years, house prices have moved 0.5% a year above inflation. So if you're asking me about where house prices are going to go over a 20 or 30-year view, certainly in our country, they've moved by about 2% a year above inflation. That's the ABSA house price index from 1966 to now. So I can't see in my mind why it will suddenly shoot 5 or 6% a year above inflation. Whereas I think commercial property is different in that we didn't really have a commercial property market of shares that you could trade in the late 90s. I mean, it just started then. Before then, Anglos, Old Mutuals, breweries, Sanlam, they all owned all the properties. So to me, part of what we're seeing now is a normalization of an artificial situation. Our property market, our listed property market is now kind of how it should have been 20 years ago. And I think our residential property market, to me, that correction happened in the 90s. When that was when the people started buying houses in all areas. So I can't see why suddenly that will now follow again next year or in the next 5 years. I can't see a driver for that.
Okay, let's take Warren's standpoint there, Hershel, and try and flip that.
Yeah.
If we say, fine, since the 60s, the residential market has beaten inflation by 2%, it's a comfortable return on your investment, but you're outlaying a lot of money up front.
Yeah.
Why would I want to then get into the market and buy a second, third, fourth property for rental purposes? What's in it for me there? Come, convince me now. Be the estate agent.
You put him to rest.
Yes, bury him.
Listen, so once again, firstly, it is a long-term investment. Secondly, and I say this carefully, you know, I'm not...
Actually, any investment
Yes.
should be a long-term investment, whatever you're
Yes,
investing
it should.
in.
Listen, if you're investing in blue chip shares, buy the shares, put the certificates
Yeah.
in the safe, and leave them
Right.
there for your kids and your grandkids.
Yeah.
I think, and I say this carefully, that residential property is one of the few investments that allows you to gear yourself to the extent that you can. Now, that got a lot of people into a lot of trouble during the boom when people were sort of flipping properties and buying properties with no deposits. But it does allow you to buy R1 million investment, as an example, with only 50,000 Rand down. And I say that carefully, don't rush out with your credit card and use that to invest in residential property. So
Right.
it does allow you to gear. And if you look at people who've built up portfolios over a period of time, one of the positive aspects is that once you've built up equity in that investment, so you've paid down your bond to a level where there's equity relative to the value, it allows you to gear up again and reinvest, whether it's in residential property or in other areas. So it does allow you that gearing. There is relatively lower risk than investing in, for example, the equity market, albeit at a lower return. So once again, you know, depending on where you are in your life, whether you're looking for stability of income, less volatility, more risk, it may be suitable at different periods of time. And I think that there are, and especially when you look, I mean, we see more and more investors in the market, and when you talk to them and say, you know, why are you buying 2 and 3 properties? I think a lot of people, it's not without danger, but a lot of people actually say, you know what, I want to invest in bricks and mortar. I don't want to have some fund manager looking after my money. I want to be able to feel the bricks and mortar. I want to be able to collect the rents and manage my own investments. You can choose to take on a property management company.
Yeah.
So I don't say that you know, there's a uniform rule, but there is no doubt that there are a lot of people over a lot of time who have done very well in residential property, and I think that it continues to be a sustainable and a good investment over a period of time. And in times where interest rates are higher and the values may drop, remember, you're also getting a yield on this. You're at different times, you may be getting a better yield and better capital growth. But I think that there are very few people over time who look back and say, you know what, bad investment. I've paid down my unit, I'm earning rental, it's part of my retirement income. I've got a capital asset that I can sell if I need to sell it over a period of time. So I think, listen, you know, there are always going to be arguments forward and backwards, but you know, those would be the key areas for me.